Listeners, we will get to intros, but before we do that, Lane, I want to ask you to tell us something that you believe about real estate that might surprise us.
You know what? I'll be honest. I don't really particularly like real estate. I'm not a guy who likes to go to open houses or likes to design like layouts of floor plans and stuff like that. I just like the tax benefits and it's kind of an old archaic business.
Welcome to the source of commercial real estate, where we talk to the experts in commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I am your host, Jonathan Hayek. I'm a former public school teacher who found financial freedom through residential real estate investing, and now I invest in commercial properties, particularly small industrial. Today, I have the pleasure of talking with Lane Kawaoka. He is an engineer, he's an active investor, he's a podcaster, he raises capital, he's involved in many different asset classes. So we are in for a fantastic discussion today. Lane, thank you so much for joining me today. How are you?
I'm doing well. Doing well. Aloha, everybody.
Well, thanks for joining me. Why don't we start out the conversation with you telling us a little bit about your background and how you got into real estate?
Yeah, I call it the linear path. I was taught to be frugal with my money, do the 401k stuff. And also go to school, study hard. And then, that's what I did. I became an engineer. And then as soon as I started to work, I was more in construction management, civil engineering, starting out. And starting out, wasn't very fun. I traveled all the time but still, brainwashed to do the 401k and then buy a house to live in. So that's what I did. I graduated 2007, 2009. I bought that first house to live in. And because I was traveling all over for work all the time, I just decided to rent out my primary residence and just live on the road. So the company paid all my living expenses essentially. And I did this for, bunch of years, where I was able to put away like almost 100 grand every year just to down payments on buying properties. Eventually bought a down or duplex in Seattle, Washington. So I had a few units up there. But this was around 2012 when the market was kind of heating up. And I realized I learned about rent to value ratios and how, these primary markets and these class A rentals maybe isn't the best way to invest. So then I did a bunch of these turnkey rentals. Eventually in 2015, had 11 of these single family homes scattered throughout the United States as remote rentals. But yeah, that was kind of halfway through the genesis.
And so tell me about those rental properties. I assume your strategy has shifted today. So you were in Seattle and investing in different parts of the country. So tell me about that strategy. What were you trying to do there?
Yeah, it's I think a lot of new investors, they might be Googling things or hearing things. I mean, I myself was doing the same. You start to hear about the so-called turnkey rental where, you buy it from a house flipper who fixes it all up, he puts tenant grade, new flooring, new tenant grade appliances, fix the plumbing, electrical, roof, etc. And then sometimes some of these guys will even put a tenant in there for you and even have the property management under their roof. And so it truly is sort of a turnkey investment. Back then, I was buying, the first turnkey I bought was like 2012 in Birmingham, Alabama for like eight. It rented for 850, and I think the purchase price was like 70 or 80 grand. So well under that. Beat that 1% rent to value ratio there, where you take the monthly rents divided by the purchase price, and you're looking for something 1% or higher. Um, but yeah, kind of just rinse, wash, repeat. Got to a point where I became more of an accredited investor from net worth distinction. And I started to interact with other purely passive accredited investors, people who had much more than a few rental properties. And a lot of these guys were doing the same thing, which was selling off the single family homes because of the high liability, headache, and moving off the syndications and private placements. And this for me happened around 2015, 16. At that point I had 11 rental properties, and I'm not gonna lie, like it was great money, right? Like, a few thousand, a few $100 coming from each property, $300,000 a month of cash flow. And this is after, you know, capex, things that happen, and, you know, expenses. This is like the true cash flow. Um, but, you know, with that came headaches. You know, I had a professional property manager, you know, for all the properties because I was busy doing my W-2 engineering job, which is the primary source of me making down payments on these more and more properties, which I needed to keep focus on. Um, but then, you know, with 11 properties, I maybe had an eviction or two every year, some kind of big issue that came up every quarter, and just became a real pain in the butt. And what I really keyed on that other people, you know, other peers told me was, yeah, man, it's a high liability, you know, when you're the direct owner in those rental properties. So that was kind of where the transition started to happen. And I talk about this in kind of my new book, The Wealth Elevator, right? In there, there's like a chart on, you go through these like sequences in life, right? Like, I mean, I think most of people listening, you're not in kind of what I call the basement level. You know, you have some net worth, you know, more than a quarter million, and you make over $50,000. That's, you know, I think that's for people, they need to listen to the Dave Ramsey strategies out there, getting out of debt. But where I started out after college was this first floor of the wealth elevator where just buy rental properties. But at some point, you kind of out of that. And especially when becoming a credit investor, net worth $1 million or greater, you kind of get to the second floor, which is becoming more of a passive investor into more institutional type of products, kind of like the stuff that, you know, you guys do today.
So tell me about your strategy today. What are you focused on?
Well, when we first started, um, you know, we would buy little 50 unit, 60 unit class C properties because that, you know, it's lower purchase price and it's less competitive and it's riskier too, right? Because the tenant base is really difficult. We eventually stepped up to larger class B assets, you know, bigger unit counts, but still, you know, tenants are tenants and, you know, they're, you know, a lot of these guys, you know, we specialize in lower class or lower middle class housing, you know, not slumlords for sure, but like, you know, people paying $800 a month to $1,200 a month rent, right? Which I believe is kind of the growing middle class, lower middle class out there. Um, so we kind of focus on that. In 2020, we realized that a lot of people think that they can just go buy 200, 300 unit apartment complexes. So wanted to leverage our expertise, you know, my professional background as an engineer, and started to develop, you know, ground up. So we create bigger, you know, equity growth that way. Um, and part of the pivot into private equity now is, you know, we saw these last couple of years. 2021 was the peak of the market. We saw a pretty huge correction in commercial real estate. You're not seeing it in residential, but you're seeing it in commercial real estate where prices have come down 20% across the country. And, you know, I think you know, to put it on the head, what kind of business plan we had prior, you know, cosmetic renovations, 3 to 5 or 5 to 10 grand per unit, new flooring, new appliances, paint job, playground equipment, you know, small light things, lipstick on the pig, some people will call it. You know, all we're trying to do is you know, increase the NOI by 10 to 20%. But when you have a 20% or more correction, all your good work is kind of, you know, washed out, which is why I think we've kind of searched for ways to create, you know, bigger force appreciation, right? So if a correction does happen, you're able to kind of swim against the currents.
What are some of your strategies for creating those larger chunks of forced appreciation?
Yeah, you know, so I call these lobster traps, right? Because a lot of it is like, you know, you're looking for the right deal to start, right, to work on. So the first thing, like I said, ground up development. You know, we have teams set up to manage multifamily assets. So it was a natural transition to create these types of assets, multifamily. And part of this was kind of focusing on our lane, right? So we'll typically build. No, it technically they're Class A, right? Because Class A is anything built, you know, 2015 or newer. But it is definitely workforce housing. It looks nice, it's brand new, but it's no frills. You know, it's not like your, you know, some people are familiar with the brand Amelie. You know, these are like the $2,000, $3,000 a month luxury rental apartments with the bar in the lobby. No, none of the such. We don't do that, right? Like my investment thesis is to create products that the majority of America, the bell curve of America, if you will, the lower middle class uses. That's one way that we try to recession proof the investment. Um, and then part of that is like, the growing lower middle class, the population growth of, immigration, and then the bifurcation of, unfortunately, the rich are getting richer and the poor getting poorer. And from what I see is a general trend, everybody talks about how there's a low supply issue, but it really is centered around the lower end, right? The middle class is disappearing. There is really no middle class here in America. Well, it's disappearing. I call it the endangered species. And that's kind of why, like, we focus on the lower middle class, provide good quality housing for those folks, stay away from the slumlord, right? Kind of model of class C assets in bad areas. But I think it's an area, it's a niche that definitely is, uh, part of the investment thesis at the end of the day. The other lobster trap that we're doing now is venture capital and private equity, investing in small businesses, right? Like, people don't realize, but this game is happening all around them. But the bigger deals, the institutional type of deals, are being taken up by your Morgan Stanleys, your Goldman Sachs, right? What we try to do is find these smaller cap operators, the guys who own $1 to $20 million businesses that might need an injection of capital, $500,000, few $1 million to do an expansion, hire more staff, pretty much magnify what they're already doing well, right? And sometimes this money is just the thing there. So in a strategic mergers and acquisitions, I mean, this is just what the big guys do. But what we're trying to do is trying to find that small niche in the smaller scale. Um, and what we do is we partner with people that we know, like, and trust. Because just like the real estate game, it's all about relationships. I mean, that's why I go on these podcasts, meet folks like yourself, right? If I'm looking for an industrial operator, if I'm looking for a mobile home park operator, or if I'm looking for a CPA firm that does roll-ups of other CPA firms out there that are retiring and doesn't have a succession plan, which that's the majority of small business owners out there are in that predicament.
Lane, let's focus on your ground up development strategy. And I love the strategy of focusing on attainable housing, not necessarily affordable, like government subsidized, but it sounds like attainable housing for the working class. And it makes a ton of sense. But in it's my understanding that a lot of the new build stuff is built to luxury standards because that's how the developers can get the numbers to work. So, can you go into a little bit about how you can manage ground up development right now with lower rents and still make the numbers work?
Yeah, and yeah, I definitely agree. Like what you said, that's like the general narrative is like, if you're going to go buy a piece of property, you're going to try and improve it to the ultimate value, right? So you're going to make it luxury. It's true generally, but I think what we try and find is like the pockets geographically, in a certain market where you have those demographics that are strong, but it can support, this kind of workforce housing. And again, I think, it's not luxury, but it is definitely nice. It's nicer than the crap I lived in when I was in college or had my first job. I'll tell you that. I wish I lived in one of these places. I think for a lot of the listeners listening, this type of product is, if you live in Texas, just to use kind of a lower price type of area, these are the things that rent for $1,300 to $1,600 a month. So it's not cheap, but definitely, not $2,000 to $3,000. So, you've got the modern floor plans, the open space, the rooms are kind of a little bit smaller to kind of suck that square footage into the living spaces. That's what people want, right? And if you can build it in a method where it's kind of rinse, wash, repeat. Just do it over and over again, right? Unit by unit. That's essentially what I see as the trend in the future, right? Like I a little bit of like city planning 101 here. Like, the previously the government thought that they could make, projects like you have in New York City, right? Which we all know is kind of cesspools for drug activity and crime. Obviously, the not in my backyard people are like, yeah, keep them there, right? But from a city planning perspective, you want to put your lower middle class people kind of scattered throughout your city. People may not like it, not in my backyard, but that's probably the best thing for society. So that's where a lot of these projects kind of come into play. You can either do an infill, or you can do it like how we do is like, well, typically, I mean, people live in all kinds of areas, but this kind of format typically is consistent, and it's kind of called the buying on the line tactic, where if you look at, you've got your highway system, and you see the exits start to develop outward and outward and outward. You start to see where that line of development is happening. What we'll do is we'll buy a good 20, 30 acres on that line of development, and that'll be kind of the target. So, again, I can't, nothing really is coming to mind, right? Because everybody lives in different places, but I think everybody can imagine, like, yeah, the development is moving out to this place. There's a new, it's a little empty now, right? There's a new like coffee shop out there. It's brand new, but it's kind of like a scattered chessboard, right? Because there's a big empty lot there. Well, that's kind of our ideal target, right? The trouble is finding a 20, 30 acre piece of plot, right? Because we're not in little single family home, 1,000 square foot plot. Like that's just unusable for us. So these plots are actually very sparse. But it's kind of, we can, to answer your question, I think part of it is we can get the pricing a little bit better for that to be able to build for that standard. And let's be honest, these are not in the city, the core business district, right? You can't even buy single family homes or apartments in there, those core business areas, to be able to cash flow anyway, right? And that's why you have to build it to luxury standards to make the money work. But what we're buying more is kind of that little bit outside of the city center. Now, some places that might be just a 20-minute drive out. Some places it might be 45 an hour out, right? But that's kind of the product material. And I think if people stop to think about it, yeah, there's a lot of these types of apartments coming up in those types of areas. Obviously, some are much more flashier than others, but if you stop and look, there's a lot of lower middle class, you know, $1,300 to $1,600 for one bedroom type of options out there. Like you say, there's a college for everybody,
Sure.
not just
Yeah.
Stanford.
Makes a ton of sense. Sounds like you're looking the outskirts of town, path of progress, not necessarily where progress is happening today, maybe, but it might be 5 to 7 to 10 years down the road. Lane, do you have any projects going on right now?
Yeah, I mean, we finished one. We focus in on certain areas. I mean, one criteria is like we like red states in particular.
Mhm.
Obviously, we're the landlord, so not going to get into that too much because it always kicks up a political discussion, which I don't want to get into today. But we look for places with the population growth improving, and usually that's caused by economic growth. Again, the red state thing. Um, so we like right now we've been heavy in Huntsville, Alabama, which has been probably the best tertiary market out there. We've got some projects north of Houston. We got some projects in Jacksonville. So these are obviously, I think, people, if you've been investing, these are cities, secondary markets, that secondary markets aren't the sexy cities, but these are the places you can, do projects for a reasonable amount, and they're somewhat stable markets. They're not smaller tertiary markets. Um, and we kind of focus in on these types of areas, and again, like it's we're kind of limited by the amount of 20 to 30 pieces of acres within that path of progress or that line of progress. that's slowly moving out.
Lane, it's interesting. You mentioned three states that are very popular for investing, but they're actually three states that I have personally identified as being states that I am unwilling to invest in because of insurance reasons, tax reasons, natural disasters. So you identified Alabama, Texas, and Florida. So I'm wondering how you think about those things. And so,
Yeah.
Houston area is becoming notorious for natural disasters. Huntsville, Alabama is a little more inland, so maybe less so there. Jacksonville, you don't hear a lot about natural disasters there, but insurance in Florida is really struggling. And so, how do you take those factors into account with the sites that you select?
Yeah, I mean, we break it down more to like submarkets, right? And what a submarket is not the state, not the city, but the part of that particular, like for example, Houston. Houston's a large submarket, but it probably has about a dozen or 2 dozen, submarkets within that market, the MSA. So particularly Huntsville is, if you look at the insurance maps, and this is where you gotta kind of dig in and just don't look at things at a surface level on states. When you dig in, as long as you're north of Birmingham, you're not going to really get hit by the hurricane insurance stuff. um same thing with the north of you get to the Woodlands and above in Conroe up there. You're well north of that. And partially that investors can do is they can, you can look at the floods, right? You go look at the FEMA maps, the 100-year flood levels. That usually is the big indicator on that insurance side. And then Jacksonville too, right? I mean, normally it's that Gulf area, the Panhandle that gets hit. Very rarely that it still has the strength once it still comes up to that Jacksonville area. Now, I'm not a meteorologist or whatever, weatherman, but that's just what the insurance maps tell me. But great places to live, right? I mean, I would rather be in there than, I mean, again, haven't really done my research on like a Kansas City, for example, right? But these are the markets that we target. And from a tax perspective, all markets have all markets that I think for good reason, right? There's a reason why people develop there. There's a reason why the market is getting hot and taxes increase because people want to freaking live there, right? Population is going up. So, I mean, I think, you dig into the details. Like we've owned properties in Harris County, right, which is the more core business, the predominantly of what you think of Houston, Texas, right? Harris County, is a huge county, but it's kind of like King County for Seattle. People are familiar with that. Harris County is very high taxes increases, so we've kind of focused away specifically on Harris County and gotten out of there. But that's how I think you're very astute to kind of picking out those states. We still like them, but we kind of try and dig a little bit more into like the submarkets like that.
Makes a ton of sense. Yeah, it doesn't do any good to paint with a broad brush. So certainly, if you're looking at natural disasters or flooding, there are certain areas of Houston that are more prone to flooding, and certain areas that are less
Yeah,
prone.
I will add also onto that, like oftentimes when these events happen to you, I mean, we've probably had it happen. I mean, we've probably had half a dozen fires alone. I haven't had too many claims on like hurricanes, right? Because like again, like when a hurricane comes through, yeah, you're gonna have things come, get knocked down. You gotta fix this, that, but a lot of that just gets taken care of on like normal operations. Like, this is why we employ handyman on staff, right? To knock it out. We're not paying third party like little mom and pop single family homeowner. But the big stuff that you got to worry about is the flooding. And that's why I alluded to earlier. You got to see where those flood maps are. Because definitely, you're talking, the southeast quadrant of Houston, definitely flooding is a big thing there. And a lot of it is, you got to know the local area, right? That's where we have, our management team actually living out there in that particular area because they intimately know what happened the last time, Hurricane Harvey came through? Where did the water go up to? And then also fact checking that against the FEMA maps. But like I think a lot of times when these things happen, it's football season now. It's like the old the defense is offsides and you kind of have a free play at it. So how that analogy kind of transfer over is like, I've had it where, like, I mean, Texas has a lot of hailstorms. I mean, you have a hailstorm event, you put in the insurance claim. I've gotten a free roof that I, didn't necessarily need, but because we are able to put in that claim, it was a free roof because of that. So it doesn't happen all the time. Probably doesn't happen most of the time, but a lot of happens where you can actually get lucky in some of these circumstances. And this is why when we are, I don't do this personally, right? I just know the person to talk to and hire out to represent us to get the maximum amount of benefits from these types of seemingly negative events.
Lane, I found it interesting to follow the trajectory of your investing from turnkey single family to getting into larger multifamily, kind of more working class, rougher properties to now ground up properties. Multifamily is kind of notorious right now as going through some hard times. I'm wondering if of any of the properties that you're involved in, either as a general partner or you own on your own, are you having any struggles with any of your properties currently?
Oh, certainly, right? When you buy a property at the peak of 2021 and the market corrects 20 to 30% on you, like Phoenix went down 30% in commercial real estate. It's well documented. And your loan is, coming up for renewal, you're going to get squeezed. And this is why I tell all our investors, you have to diversify over it. The biggest thing is time, right? For two reasons. Number one, in the last 10 years, it's been a gradual bull market. When there is a correction, you will get caught. And this is the part of investing. But for projects that were entered in prior to 2020, number one, you didn't buy them at the peak, but number two, the business plan was able to get implemented and absorbed, right? And again, I think that's what's difficult about, everybody talks about value add real estate, right? You have to, again, dig a little bit deeper and like, what do you mean by value add real estate? Number one, are you developing from ground up? Because that's value add real estate. Or are you just putting some lipstick on the pig, changing out some flooring, appliances, bumping the rents up a couple $100, which is just increasing the NOI by 10-20%? That's value add real estate. Are you just doing nothing and just putting in a new management team and just bumping the rents up $50 to increase the NOI by 5 to 10%? That's value add. But those other two examples I gave, if your market corrects 20% on you, you're still underwater, right? But that's part of investing. The last 10, 12 years, it was good times, and these strategies work phenomenally. Now that's kind of why I think maybe there's a little bit of a trend to go to projects with a lot bigger value add, bigger buffer, one would call. But yeah, it's unfortunately, there are winners and losers in every transaction. Many of the projects that we buy, in fact, pretty much all of them, I think we were on the winning side of the transaction from a distressed buyer or just distressed seller selling to us. Sometimes it works the other way around. And that's, I think if investors don't understand that, that's what the stock market is for. But, you're going to be, constantly screwed over in that world, right? Like, and this is part of investing. And I think that's what's tough for investors who jumped in 2021, 22. It's like, you get out of your comfort zone, you do everything that you kind of think to do, and then you get your hand hit on top and you get this bad taste in your mouth. And that's, to me, I think that's the hardest thing of all. Like, to me, it's like, I'm very passionate about this because, it worked for me. And I think in most times, if you dollar cost average, through at least 5 to 6 years, you're going to see the rewards of going down this alternative investment path. But certainly not for everybody, right? I mean, if everybody did this type of stuff, in 5, 10 years, who would be our teachers, right? Who would be our engineers? Who would be our doctors, right? I mean, financial independence is not for everybody.
Lane, will you talk about maybe one relatable struggle that one of your properties is going through that maybe you purchased in the last 3 years? And how are you working through it that people can relate to? And how are you working through it in a way that 5 to 10 years down the line, you're going to be better off for it?
Yeah, I think one case I'm thinking of, it's actually quite frustrating. We I think we purchased this right before the big run up. Um, increased rents from like 800 to over 1,000. And then obviously completed well over like $3 to $4 million of renovations. So, um, most times in these projects, we're not looking to decrease expenses, right? Because we're trying to improve the product offering, and that freaking costs money, right? Month after month from operations. So, but overall, NOI increased. But when you kind of look, the cap rates is what the markets are selling at, right? The market, and that's out of our control. That's what the market is at. I mean, that's why we haven't really bought anything since the summer of 2022, because with the interest rates high, this creates the new buyers dynamic where their holding cost is higher, their debt service is higher, so they can only pay so much. So that's what's created this dip in the market. So so the property just is valued lower, but the property is kind of worth the same thing that we bought it for, which the original business plan was not to get to this point until 5 years in. And here we are a few years in, halfway, maybe 60, 70% to the business plan, I think, when I last checked. Um, but it's just frustrating, right? Because, I mean, from our point of view, it's calls, a lot of people's hard work and energy goes into it. And when you look at the score, it's like you did nothing, right? Obviously you did something on the inside, and it's just a market. But I think that's the thing that is a little bit, well, very, very demoralizing for sure. I think on this particular one, we can kind of do a slight cash in refinance to get over the hump. But you know, I mean, unfortunately that's not the case for some other projects out there, right? Where you bought it for 80 million and it's worth 60, and your senior debt is 70. You know, unfortunately, like that money is not going to come back. The market is not going to bring back that value, even with interest rates, now this week coming down 0.5%. You need it to come down more, because the interest rates are not directly correlated to what the supply in the market is dictating what the prevailing cap rates are. In other words, just because the interest rates come down 1% does not mean the cap rates in the market that the assets are trading at is 1% lower immediately. I don't know if it's 6 months. I don't know if it's 5 years. Nobody knows that. But what I do know is, I mean, underwriting new deals today, I mean, it's just night and day. I mean, you're picking properties up for like, I mean, I was just looking at another deal, price per unit, 110 per unit. That was built 2003, I think. You're picking up properties for 110 a unit a couple of years ago that were 1970 vintage. It's 30 years newer for the same dang price. Um, I think there's a narrative out there that people think that there's a lot of these like looming debt out there that's going to come in. That's always the narrative. That's been the narrative since I started. That's the fear of doom, the doom and gloom thing that get everybody freaked out. But I would say for investors out there, if you're entered into a deal, you've established that basis in the price, right? The basis is what you purchased it for. You cannot shake that. It is always going to be that basis. And some of these properties are just picked up with that higher basis, right? What right now is kind of, if people see what's happening out there, the bases have been reset 20% at least to the lower end. You know, it's a new day. you know, you know, the other properties, I think a lot of people are just holding on to them and they won't make any money on it, but then they're just delaying that inevitability for 5, 6 years on it. But the opportunity is with kind of the deals where the base, you can pick it up with a fresh new lower basis, unfortunately. And this, I think a lot of us who are under the age of 40, some even under the age of 50 who got started later, this is probably the first market cycle you've seen. I mean, I've seen a couple of these. The first time I didn't really do anything because I didn't have the dry powder to go after it. But now I'm starting to see the patterns, right? These things happen every 7 to 10 years, maybe a little bit longer now because we're kind of in this artificial, world where the Fed can just thinks that they can just print money apparently. But it's just the same consistent thing. Things go up very slowly and then they come back down and correct very quickly. And it just repeats over and over again. Business cycles. Real estate has them too.
Lane, I've thoroughly enjoyed this conversation. You have a ton going on and lots of ways people can connect with you and learn more about you. I want to give you a minute to talk about how people can connect with you if they would like to.
Yeah, I mean, I would say if you guys are looking to books, I just finished my second book, The Wealth Elevator, which, especially if you like tables and charts, I have this chart where it kind of shows where you are in the wealth building journey. Or as I kind of separate it, there's a basement floor, there's a first floor, second floor, and then the third floor, penthouse and beyond. I think when I first started, I was in that first floor of the wealth elevator. Now I think a lot of folks out there, myself included, are in that second to third floor of the wealth elevator. And it kind of shows like, hey, what should I be doing? Investing in real estate, should I even be doing a retirement plan? What should I be doing in taxes? Where should I be keeping my liquidity? Things like that. Because there was never a book out there created for, we call ourselves wealthy, I guess, right? If you have $1 million, you're wealthy. But in reality, as I've kind of climbed the wealth elevator myself, what you want to try and do is get to this end game level of $4 to $5 million net worth. Because at that point, you can just give it to your spouse or kids who may not be interested in this stuff, and they can have a good life at 5%, 4% returns. But your role, I think, as the steward, most of our folks in our community are first generation wealthy. They're the ones who created it. But it's this idea of, yeah, you've got to go into alternative investments. You got to take on a little risks, right? To get something, to forge a new path, like yourself, Jonathan. I mean, who would have thought, right? A teacher, like my wife's a teacher. They don't get rich, right? By just doing the same old TSP, going to job, trading time for money, right? You got to do something different if you want something different. But yeah, check out my book on Amazon, The Wealth Elevator. You can kind of see where you're at. Maybe you're on the higher floor, or maybe you need to pick up a Dave Ramsey book or the Rich Dad Poor Dad book, which is mainly predicated to the lower net worth individuals. But I think what I've realized, certainly for myself, is that there were clear transition points that if I wish I would have known now, I think I would have expedited my journey on the path to financial freedom and beyond. But if people are interested in podcasts, I've been doing my podcast since 2016, The Wealth Elevator. When I first started, I was talking a lot about like buying turnkey rentals, little single family homes. Obviously after 2020, started to do more of the syndication, accredited investor type of topics. But if people want to connect, they can reach out, lane@thewealthelevator.com.
Great. Lane, this has been a great conversation. Thank you so much for joining me.
Yeah, thanks for having me, Jonathan. Appreciate it.
Listeners, if you enjoyed this conversation, feel free to reach out to either one of us. We clearly love talking about commercial real estate and we would love to connect with you. Make sure you follow and subscribe this podcast wherever you are listening or watching. Thank you so much for joining us. We appreciate you. Until next time, take care.